The market's going to crash. What do I do? What do I do? You know what you do? Is you look out the window. You look out the window. That's what you do. Just look out the window. Because the market crashes all the time. All the time. And a market crash that, was it not Ray Dalio? Who's the other guy? Jeremy Grantham is suggesting a worse than the Great Depression. Who's the other guy? Harry Dent. Look, these guys may be right. They may be right. And I'm not here to say they're wrong. I have no idea. You have no idea. No one has any idea. But what you do is you look out the window because there's nothing to do except to avoid it in the begin with. And this is what I want to talk about here today. You don't have to be in stocks, for heaven's sake. There's nothing that says you have to be in stocks. Now, a lot of stock market proponents will say, well, you have to keep up with rising costs of living, and stocks will do that for you. I said, will they? Really? Because they didn't keep up with the falling cost of living in the Great Depression. They did not keep up with the rising cost of living from 66 to 82. They just did not. It did not happen. In 82 to 99, there was a leveling of inflation, actually a decelerating of inflation, and stocks did great. It was 18 years there. It was freaking fantastic. This last 10 years, fantastic. Low inflation, high stock returns. Start the 80s was high inflation, but it's decelerating in high stock returns, 80s and 90s, and the teens. All right, so we've had 3 decades of insane growth over the last 4. All right, but that was sandwiched around the aughts was basically a Great Depression part 2. All right, and there was hardly any inflation then, and the stocks did not do anything. They just did not. Sandwiched by high inflation of the 70s, and stocks did not do anything. They just did not. Now, they didn't go down in the 70s, and if you had reinvest dividends, you did make money, but not net of inflation. You just did not. And then you factor in taxes. That's the whole thing about it being taxed on illusory gains. So you start with $100,000. Inflation got you $200,000 just that alone. All right. So the cost of living went from 100 to 200. Your stocks went from 100,000 to 200,000 bucks. You had to pay taxes on that $100,000 gain, even though it was all based on inflation, just the price of goods going up. Had nothing to do with your performance of the stocks. You still had to pay tax on it. So it was a phantom income that you made for which you had to pay tax on. It's evil stuff, man. Anyway, it's okay to sit it out if you're worried about it. I guess someone call me. Hold on a second. Let me just delete this. People just keep calling me, man. It's okay not to be in the market. Now, I am in the market because I believe in the stock market. And I hate to say the stock market, but I believe in owning the companies of the world, as well, basically the U.S., but the companies that are creating products and services that we're always going to use and need. I believe in that. I'm also working. All right. I'm also making money. I'm also adding to my portfolio. Now, I remember back in the late 90s when I first started Vanguard, Ginnie Mae was paying about 6.25, 6.5, something like that. I can't remember, but let's just say 6. I forgot, but something like that. And I said, man, if I had $1 million in Ginnie Mae, if I had $1 million, I'd park it, and I was retired, I'd park it in Ginnie Mae and live off the interest. $6,000, $60,000 a year, $5,000 a month plus Social Security. I'll be good to go. But Josh, you got to keep up with the rising inflation. Well, stocks would do that. Well, what proceeded to happen? They did not keep up with the rising inflation. Not the next 10 years, man. They did not. Simply did not happen. And inflation wasn't very high, but the facts were the stocks fell off a cliff for the aughts. Stocks fell off a cliff in the 30s. Right? The stocks did not keep up with inflation in the 60s and 70s. It just didn't happen. That's the thing is people think this, we've had the 50s, the 80s, 90s, and teens. And everyone's like, well, the market, and then if you go back to 1800s, there was no inflation, so we can discount that for a second. But there is no rhyme or reason to say stocks will keep up with inflation. It's kind of like people say gold is a hedge against inflation. I'm like, is it? Really? Because if you look at gold, it certainly hasn't hedged against inflation at all. The point being is that I am prepared for a major loss in the stock market. At least I think I am. I think. If it were to happen, that sucked, dude. You see, that's what happened in the last year. I remember my portfolio was like, damn, what was X is now X minus 30%. It's like, ugh. Now we're well above that, which is great. I wasn't taking money out, thankfully. I still had income coming in. I was still working. I was still adding to my portfolio. Now, if you look at my M1 account, in fact, it looks freaking fantastic. So I was just plugging away, plugging away, plugging away. When the market was down 35% or whatever it was. And now it's come roaring back, made up the gains plus some. It's nuts. But if I was retired, would I be so encouraged or inclined to just hang tight? The issue is you got to prepare that. You got to see, this is what you got to do. You got to tell yourself, man, can I handle this? And really think about it. Don't just say, can I handle this? And say, well, the stock market's always come back. That's fools. That's foolish. That's foolish talk. The stock market's always come back. That doesn't mean it will. Doesn't mean it won't. Just no one has any idea. But the idea, well, the market's always bounced back. We don't know that to be true. Because that's saying the future is based on the past in this regard. We have no idea. It does until it doesn't. And then you just look at Japan in 1990. Basically, the Nikkei, well, not basically, the Nikkei is still lower than it was on a price-to-price point from 1990. And if you're pulling money out, you're doomed, man. You're destitute. Did the Nikkei keep up the inflation? Even though there wasn't hardly any inflation in Japan? No. It didn't, because the market declines hurt much, much more than the increasing dividends that were theoretically keeping up with inflation. So, I mean, an increasing dividends, we'll just say 1% a year to offset inflation at 1% a year. That's great. But now I'm 30% declined, 40% declined. How long does it take to get that back? So the issue is you gotta prepare yourself if you're going to be in stocks for the likelihood, which is pretty significant, highly probable actually, that you're going to deal with a 30% decline in your retirement. And there's no guarantees coming back, none. But it always has. Okay, it always has until it doesn't, man. And Japan still hasn't come back. All right, that's just a fact. And so what I tell people all the time is like, let's just say you got $1 million for simplicity, all right? And we're going to say you need $5,000 a month. All right, so you got $1 million, you need $5,000 a month in income. You got $30,000 from Social Security. So you need $60,000 a year. Wait, 5,000, yeah, 60,000 a year. You got $30,000 from Social Security. Yeah, so you need $30,000 from your investment portfolio. You know, you can buy some freaking, you can go heavy on fixed income stuff to get you that $30,000 a year. You can do an annuity to get you that $30,000 a year. Drawback about annuities, that is a fixed income. It literally will not give you increases at all. But still, there's ways you can skin this without even going heavy in the stock market. So you can say, okay, I'm going to put $80,000 into 80% into fixed income and 20% into stocks. And those stocks, I'll just pretend they don't exist. There's a whole bunch of different ways to skin this cat. But when you're retired, you don't have to be in stocks. You don't. But I need the stocks to grow. Okay, well, what if they don't, man? That's my frustration. I tell people all the time. Yes, I know you need it to get growth, but what if it doesn't happen? History is replete with stock market crashes all the time. And if you're pulling money out and you're like, I need money to live on, and now stock market crashes, you're in a world of hurt. Bonds won't crash like that. Well, historically they don't. Who knows what they will do? But theoretically, bonds, Treasury bonds, for instance, are the risk-free security. All right, so Treasury bonds are guaranteed not to go bankrupt. That's just a fact. Now, will they have any purchasing power? I have no idea. But let's just use some common sense here. Say, okay, I was invested, like me, 100% stocks, a little bit of cash. That's what I'm invested. I'm 50 years old. All right, plugging. All right, I got 4 kids, blah, 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 blah. All right, so now I'm making big money now, which is great. Now I fast forward, so I'm 65. I'm not making any money. We'll just say I got $1 million. I need $60,000 a year to live on. I got $30,000 from Social Security. That's a 3% distribution rate. You can do that with fixed income until you're blue in the face, man. I mean, yes, you're going to touch the principal. Whoop-de-flip-a-do. You say, okay, I'll put $800,000. I'm going to take $30,000 a year on that $800,000. I'll put the $200,000 in stocks, and I'll never touch the stocks until I run out of the $800,000. And by that time, will be 20 years from now? It's most likely that $200,000 would be $800,000, or not. I don't know. But why just stress out over this stuff? It's weird. And why listen to these guys? The market's going to collapse. Okay. I mean, what are you going to do about it? The only thing you can do about it is say, I'm not going to be part of that and not have stocks. Or say, I'm going to be part of that and recognize if it does happen, I have a plan B, which is I'm not going to touch those stocks when they're down. There's only two things to do. That's it. So figure out where you're going to be. Say, I don't want to play. I don't want to participate. I've won the game. I don't want to participate. Or say, I'll deal with it. But I know that if I have $1 million, I know a 40% decline means I'm down $400,000. That's how you got to look at it. Can I handle that? And remember, once you're down $400,000, you don't know that you're only down, that's a stop. That's the thing I think a lot of people look. Can you handle a 40% decline? Oh, yeah, I've handled before. All right, now you're retired. Can you handle a 40% decline? Oh, yeah, because I know that happens a lot. All right, but now you're March 9th, 2009. S&P 500 is down 54% from October 2007 to March 9th, 2009. Can you still handle that? That was the bottom. Did you know that day? No, no one did. But that was the bottom. Were you sitting there thinking, man, I got to protect what I have left? That's what you have to think about. You don't know that that's the bottom. That's the problem. When that time comes, you don't know it's the bottom. Hindsight's easy, but we're not looking at hindsight. We're looking at foresight. What's coming down the road? How do we prepare for that? It's like, I don't want to play in that. It's okay. It's okay. No one's going to yell at you. And people say, you're stupid. Who cares what people say? Are they going to pay your bills? No. You got to do what you got to do. Don't lose sleep overnight. I will see you.